Hi everybody, this is Ted Bauman today. I'm speaking to you about one of my products called the Alpha Stock Alert. Now for those of you who subscribe to the Alpha Stock Alert, you'll know that it's essentially a rules-based system, which means that we use extensive backtesting of data going back 10, 15, 20 years to try to identify indicators that serve as a pretty good indicator of where stock prices, individual stock prices, are likely to go in the near future. I've written extensively about this in the weekly alerts for the Alpha Stock Alert, so I'd encourage you to look at that for more detail. But what I want to talk today about is our hedge position. We've maintained a hedge position which is essentially 50% of the portfolio, which over the last 4 months has actually been shorting the market. In other words, we have been holding a position, an ETF position, that essentially shorts the Standard & Poor's 500. Now, a lot of people have asked, why are we doing this in a context when the market seems to be in an epic bull run? And I want to address that today because I think it's really important to understand why we do it and why it's so important that you take that kind of approach, that part of a rules-based system, seriously. First of all, when we pick our stock positions in the Alpha Stock Alert, we use indicators that are really organized around things like value, momentum, sentiment, quality, etc. Now, essentially, we do the same thing with our hedging position, but the critical thing is that when you look at sentiment towards a whole market, for example, as opposed to an individual stock, you have to take into account a very different set of underlying factors. So today I just want to share with you some of the underlying indicators that we use to determine whether we're long or short the market in the Alpha Stock Alert. First of all, one of the things we look at is how much cash institutional investors are holding as opposed to stock position. Generally speaking, the more cash that big institutional investors hold, that means that they're basically keeping back some of their, they're keeping their powder dry, as they say. They're trying to make sure that they have cash available that is not subject to the risk of a sudden correction. And what that means is that the more cash we see in the hands of big institutional investors, like mutual funds and so on, the more likely it is that the market is really worried about a potential correction. And that's what we've seen recently, is more cash. Another indicator would be the percentage of traders who are long or short the market. There are a couple of ways of looking at that, but one of the most important is basically by watching what investment decisions big investment houses are making. Are they buying options? What kind of options are they buying? That sort of thing. And again, over the course of the last 4 or 5 months, we've seen a trend where there's increasing sort of conservatism, I guess you could say, on the part of large institutional investors. Now, the other thing we look at is basically what we call put-call ratios. Now, those are basically options, and the put-call ratio is basically if you take all the put trading that's going on and divide it into the call trading that's going on. In other words, people who are short the market versus people who are long the market, or rather people who are short specific stocks versus people who are long specific stocks. Over time, you can get a sense of what the market is thinking. Now, over the last 4 years, really, the put-call ratio has declined. And what that means is that the majority of people who have been buying options have been buying options that are long options. In other words, they're betting that stocks are going to rise. Now, on one level, that looks like it should be an indicator of a confidence in a bull market. The problem is that when you see an indicator like that going on too long and getting too low, it's sending a signal that the market is basically running out of steam, that it's likely that there's going to be a correction. And historically, when we see this long, really 4-year trend of the decline in put-call ratios, the result is usually a correction of some kind. Now, I've mentioned a lot about the behavior of big institutional investors, and that's for a reason. In the last couple of weeks, there's been a lot of news reports about how retail investors, people like you and me, have been pouring massive amounts of money into the stock market, keeping very little cash, basically trying to take advantage of it. What we see on the institutional side, though, is hesitancy, hedging, a decision to, basically keep cash, basically not to be overexposed to the stock market. Now remember that the institutional investors are the big guys. They're the ones who have the inside information. They're the ones who have the high-priced analysts who, basically it's their business to make sure that they make the right calls. And when those people are basically saying, look, it's great that we have a robust, rising market share, but when it gets to this point, it's time to basically be careful. Now, the Alpha Stock Alert system does exactly the same thing. We use the same kind of logic that they use, the big investors, and we make that available to you. In other words, we do the same kind of analysis they do, and we have one decision that we can make. Are we going to go short or long? And over the last 4 months, the decision has been to go short, and for the reasons I've just discussed. But remember, you have to be short when the market turns. You can't do it the day after, because the price movement that happens in those few moments of the few, even a few hours of the first day of a drawback is really the one that counts. So by remaining in a short position over the last 4 months, we're basically doing the right thing with respect to the long-term trend of all the indicators that we follow. And remember, the Alpha Stock Alert system is a long-term system. It's not designed as a short-term swing for the fences system. I hope that answers some of your questions about it. Next week, I want to talk a little bit about how we look at the relationship between bond yields and the stock market, also to determine our hedging strategy. Ted Bauman speaking to you from Banyan Hill Publishing. Take care.